Strategic Advisory Services Roundtable Series. Today, we're going to be going on a topic that says, is it time to stay or is it time to go? As we come through the pandemic, we have seen many, many challenges this past year. And as we head into 2021, there are a number of things in front of us that will bring both reward and risk as we go forward and try to recover from what's happened in the prior year and the years before that. Today's roundtable will be a discussion with Mike Bowers of SB Holding Corporation and Josh O'Brien from Frost Brown Todd. I will introduce both of them in a second. The key thing for this roundtable is that for those of you that have a business or own a business, we want to get out some questions that address some of the issues out there in terms of, is this a great time to be looking to exit the business, or is this a great time to be looking to be in the business and take it to the next level and take advantage of the opportunities that lie in front of us? With us, we have Josh O'Brien, who is a senior mergers and acquisition partner with Frost Brown Todd, and he will bring a perspective of both the client and what he's seeing out there in deal work and some of the challenges that they're facing today. We're also very fortunate to be joined by Mike Bowers of SB Holding Corporation. Mike is probably one of the most successful serial entrepreneurs in the state of Kentucky, has just an unbelievable track record, and is always overly optimistic, but not for him, only for the rest of us, because Mike always achieves what he sets out to do. The rest of us just look in awe. So we're very fortunate to have these people. So I'm going to introduce Mike first, and then Josh, and let them give a little bit of their background and history, and then we'll start in with some opening questions.
All right, thank you, Matt. That was you're very kind. Since I'm probably the oldest one on the panel, I could have a long intro on my background, but I'll spare everybody the problem on that. I really have been started my career in banking, ran a number of banks. I'm an old credit guy. Somewhere along the way, I decided that banking really wasn't for me. Got into the consulting business again with banks and credit unions, doing strategic planning, those kinds of things, and then developed a product, primarily hardware, selling to banks. My company was acquired, assimilated into 8 other companies about 1999, and it was a public company. Ran into the bubble bursting right after that, and bought the company back. And I bought it back with a partner, and who is now also my wife, Dana Bowers, who we started a company called iPay Technologies. Did that in 2001, sold it to Jack Henry, had a very successful exit in 2010, and then started another company called BenMinder, which is again selling to banks and credit unions. And it's a third-party risk management company. In addition to that, we help run 4 or 5 other companies, and are very involved in the community on various boards. In fact, I just got off of one this morning. So, but enjoy being a part of this group and this community.
Thank you, Mike. Josh, you have a very good background as well. And you can, I think everybody would be interested in what you're doing in the marketplace that you play in.
Sure. Thanks, Matt. So Josh O'Brien, Frost Brown Todd. I am a corporate attorney focusing on M&A transactions. I'm a native of the area. Went to college at UK and graduated, and didn't know what I wanted to do really. So I went and worked for a nationwide plumbing and HVAC wholesaler for 6 years, and really learned the business and learned the ways of the business, learned about the supply chain, but decided after 6 years I wanted to do something else. Ended up going to U of L to get my MBA and JD. Got out in 2008 and landed at Frost Brown Todd, and have been loving it here ever since. As I said, focus on M&A, representing both buyers and sellers in the lower middle market, and in this this is certainly an interesting market, and it's going to be a fun conversation today, I think.
Yeah, I think we're going to have a lot of fun. We've got very experienced people around the table, and as we start out the conversation, we take a look at the current economy, and there's a lot of mixed messages inside that economy. We have a stock market that's hitting record highs. We have interest rates that are hitting record lows. We have unemployment that, relatively speaking, is fairly is okay. It's not the lowest that it's been, but it's also not the highest that it's been. Uh, if you go to Main Street, you find that there are a number of people that can't find people to fill jobs, even though the unemployment is high, which is an interesting contradiction. Trying to find unskilled or lower skilled workers is almost impossible these days. Uh, you have businesses where the supply chains are very, very tight right now, and demand is picking up. You would think that you're on the verge of an economic explosion. Yet on the other side, there are many contraindicators when you get down to Main Street with a lot of clouds on the horizon. So, Mike, my question would be for you as somebody who's done this before, been on the ground, has operating companies now, and has companies that you control that are in various stages of their life. Some are younger, closer to startup or newly emerging. Others, as in the case of iPay, which you have exited, were full cycle. What are you seeing out there in terms of the realities on the street and the challenges that lower middle market companies, those companies in the sub $100 million revenue range, are facing today?
Well, I mean, I think there's a mixed bag of companies out there, and their struggles and or their opportunities. And some industries that we talk to, actually, most of them, quite honestly, are all doing well, and it's a variety of kind of industries. And but there are some that for whatever reason. They just ended up on the wrong side of the industry, the wrong timing. And so, but what we're seeing though, even in our companies, we've had one that went bankrupt this year. It had nothing to do with the virus. It was having to do more with market than anything else. We had great people, great concept, all those things, and it had problems. The rest of them, quite honestly, are hitting phenomenal kinds of numbers. And but so it's there's always opportunities. I think there's opportunities for good companies, for well-run companies, and yeah, business is hard. I mean, I'm not sure that I've ever gone through a year where it didn't have issues in there. Some not on the scale that this one is, and I think that's what's clouded a lot of the conversation. Is when you have a national catastrophe, it's different than having a regional one. I mean, we have regional ones. I mean, you got hurricanes and fires, and but you don't have a national one, and nor a global one. 9/11 was probably the only one in my history that when I look back, I'm going, that really rattled a lot of the thinking of businesses and where we were headed. And this one is too, but there's some great opportunities out there. So no, it's we hear a lot of consternation, but we try to blow past that as much as we can.
So when you look at your companies, and I think that's true in any situation. Businesses are not built for only the good times. Successful businesses, as you both well know, survive and thrive because they can adapt to the challenges, overcome those challenges, and actually change the dialogue in the challenges by being able to create their own mission and vision and dialogue, and disintermediate in other places to get through the problems. And in your particular case, Mike, a lot of your tech companies happen to be technologically embedded. There's a high tech aspect to them. As you look at the traditional older line types of world out there, putting on your ex banker's hat, and you look at the credit facilities, the amount of money we've printed, and you look at some of these small fab shops and small labor intensive shops. Do you see different types of challenges for them as they go forward in this economy, or is it all new economy going to be all new economy?
Well, you can't just jettison, the people that happen to have a tangible product. You can't do that. I think the people in that industry that I talk with, it's all about getting people. I mean, manufacturers just cannot. And they've tried everything, and they keep trying everything. There is a real change in the workforce mentality. And they've thrown money at it. They've thrown employee participation at it. They've thrown all kinds of wonderful, enticements, but they're having very very little luck. And it's one of those things that I'm glad I'm not in those kind of industries. We have the same, but we still don't get a free pass in the technology business either. I mean, we have trouble finding, engineers. Our tech people are the same way. It's a different mentality to try to induce them to come to work for us or for anybody. It's just a lot of money, and then they end up not really wanting to work. It's the same thing on the manufacturing. So I don't know if there's really any difference between the manufacturing and the tech end. It's hard, and I think that's why technology begins to play a huge role in the strategy for all of the companies, is because they just don't. None of us seem to be able to solve the personnel issue. And so you almost have to find a way to eliminate those personnels with technology, and you get the right kind of motivation. You got great people out there doing wonderful things. It's just this will be a theme. It is hard work. It is hard. I don't. It seems to be harder to solve some of these personnel problems than it used to be. But that's the one that all of the CEOs that I talk to today, that's their main issue.
Yeah, I think we struggle with that every single day, and it gets down to productivity. I don't want to attack any single generation, but there is the whole, our generation looks at the millennials and wonders, has the work ethic really dramatically changed and the value system dramatically changed? But I think the bigger point in what you're talking about, and this goes to Josh, is qualified labor, qualified resources in the human capital area are scarce, and there's not enough to go around for everybody. And with that scarcity, there's two ways to solve it. One, eliminate the need for it, which is the technological revolution that leverages the human skill set. Or two, consolidation, where you remove redundancies and you use fewer to do more, so bigger is better, and we get into growth side. So Josh, my question would be for you, being in the M&A market and looking at that, are those two themes that you're seeing come to fruition as you work with your clients, in terms of either exiting or in terms of consolidating to grab scale so that they can overcome the acquisition? Because a lot of times the acquisition, it's not just about getting the customer list. There are good human resources in companies, and it may be about grabbing personnel, which is not marked in the valuation in a lot of cases, other than the implied results. But sometimes grabbing personnel can be the best part of the whole acquisition. Josh, what do you think about all that?
Well, I will say you kind of stole my answer there, Matt. But that's definitely it's definitely an issue, and obviously it depends on where the company is in the life cycle. I mean, and how labor intensive and technologically intensive the company is. But to answer your question broadly, yeah, I mean that's going to be a big part of any decision. Is there a major capital expenditure looming in order to get up to the level technologically to get where we need? Are we going to go out instead to find an opportunity to consolidate the business or create some synergies by acquisition, or are we gonna sell to somebody else and take advantage of their ability to capitalize on the synergies that we provide for them. That's those are the basic, and that boils them down to very basic ideas, but that is where a lot of the sellers in the market are the market a lot of sellers are facing. I think from the buyer's standpoint, it's can we add this company for to create synergies, or do we have a process and a system? Thinking about some private equity firms that we have a value creation model where we can come in and streamline operations and take out some of that fat, and not only get the synergies but also create additional cash flow and revenue. So it's a little all over the map, but yeah, there's a lot of folks that are looking at can we either replace our workforce, or not replace, but advance our workforce, or are we going to have pay the piper and reduce the need for them?
Yeah, Josh, can I ask a question on that? Just in your model, do traditionally when you buy somebody, there are some redundant kind of functions, personnel, finance, etc. But does it take into consideration the frontline workers, the people who actually produce something, or is it more heavily on the operations, on the admin side?
To a certain extent, yes. I mean, to a certain extent, I agree. It's different for different buyers. Obviously, a strategic buyer can come in and reduce some of those top level redundancies, but they still need the on the ground workforce. But we have clients that come in and have that they look at every system and every process, and there is an ability to eliminate the need for some of that frontline workforce, or use it in a way that is more advantageous to the company. So I don't think there's a one size fits all answer there, but let's take a financial by PE firm that comes in and doesn't have the redundancies necessarily. They may have some at another portfolio company, but they're not a strategic buyer that already has some infrastructure or similar infrastructure in place. They're typically going to look at current management or quick replacement management, and then try to streamline the workforce all the way down the line, or streamline the processes all the way down the line to eliminate some need for the workforce. And versus a strategic buyer that is either doing an add-on or a consolidation, where they can eliminate some need for they'll eliminate the need at the top level, but also eliminate some need at the frontline workforce.
I think that's really a good point. And to tag on to that, I think there's a clear distinction on your last point. When you're acquiring a platform company, it's one form of evaluation. When you're looking at a bolt-on or an add-on, it's different. And in the work that we do when we do the acquisitions, we find that the management piece is the easiest and biggest target that's out there, because it's very clearly defined as to CEOs, CFOs, those kinds of sales and marketing and those things. And you can identify and you spend the most time with them, because that's where the value proposition is for many of the buyers. What we try to do is we take them to the second level in many cases when we're doing a buy side, and we want to understand, to your point, how are the processes engineered? Is there a way to recalibrate or reallocate the resources underneath? What resources do we have that we could bring to the table? Where can you consolidate warehousing? Where can you consolidate manufacturing or output? Where can you consolidate the shipping contracts and things of that nature? And if you do one of these deals and you do a thorough job for your client, they look at all the things that Mike was talking about in terms of not just the admin, but the front line. And it becomes a question of who's got the right software systems and how many of those do you need? Who's got the right technology? What's the transition period to that? And I think that in many cases, I've seen buyers in the past when I've been on the sell side, they have stepped over those questions in a quest to complete a deal, and they're focused on the top line or focused on something else. And I'm more than happy as a sell side rep when I do the sell side to let them move through all of that stuff and basically give them the answers and also focus on more on the ad backs than I am on, defending value disruption or remediation. So, Mike, to your point, I think that the admin is interesting, but the models have to really look at the front line because at the end of the day, that's where the rubber really meets the road. And you have the greatest management in the world. If you have weak employees that can't produce efficiently or systems that don't work, I don't think it's going to make a difference for you. And I'm sure you've seen that in your career, haven't you, Mike?
Well, yeah, and I mean, you make a good point, and it sounds good. I've had a local car dealer, family owned for 15 generations, and we bought a car recently, and sight unseen brings it up. We ordered it, kind of stuff, to deliver at the house. So I asked him. I said, "Look, I need to ask you something." I said, "When was the last time you had somebody on the lot buying a car that said, 'I'd like to look under the hood'?" And he looked at me like it was some, what? And he said, it's probably been about, I don't know, 2 years. And I thought about that, and I had looked. It's been years since I've looked under the hood. I don't know what I'm looking at anymore. You can't see anything anymore.
That was surprised 2 years. Honestly, I thought it was going to be much longer. But
Yeah,
I think
well,
much longer. I wouldn't even know what to look for if I was looking.
well, and that's the point. And so I listened to you on whether it's on the sell side or buy side, and we really kind of were talking about more like, the ability for the people to deliver. I'm not sure a lot of people make plant tours because I don't think they know what they're looking at. And so that's why my question, I guess, is: do they really do that? Do they really look hard at the operations side?
I think they do, and there's a difference in my experience. And Josh, you correct me if I'm wrong. When Bob knows Ted and Ted knows Bob, and they decide that one wants to sell to the other, I think we get what we call the skating pond look. They skate along the ice, never really just making sure it's solid enough, but they never really check what's living underneath the ice. So when it defrosts, they don't have the Loch Ness monster underneath them. I think when you've got these PE groups that come in, they tend to be much more sophisticated. But in my experience, the PEs in many cases can make a drastic mistake, and they come in with the MBAs and the analysts, and they live in these balance sheets, and they forget that it's human beings that make companies come alive, and they sit here and financially engineer it with these crazy charts and waterfalls and everything else. And we look at the work that they do, and I'm thinking to myself, my God, this is so complicated, and it's telling me nothing about the reality of the company. It's just giving me all this mumbo jumbo forecasting of what it could be to financially engineer to a multiple for a fund that maybe will get an exit. But at the end of the day, the exit's only going to happen if the company performs. And so, to your point, I think the smart buyers have really good advisors that will rep them into it. I think many of the PE companies have way too much money and are very good at raising capital, doing deals, and sometimes in way overpriced multiples. And the operations, not so much. So we actually have a practice that's beginning to focus on the PE companies because they have underperforming portfolios, and there's 6 people controlling billions of dollars that have absolutely zero experience. And like your example, they don't look under the hood because all they would do would be like me. If I looked under the hood, I'd say, "Oh, it looks clean. I don't know what I'm looking at, but it looks clean."
Yeah. Well, and I agree. And I will say, we work with one PE firm in particular who they are focused on operators. Their partners are former operators. and at significant manufacturing firms, and they know manufacturing and they know it well, and they are very successful. But we also work with folks who, like you say, have not lots of fancy charts and spreadsheets galore. Who, if it came to a plant floor, they would be lost. So it's certainly, I guess the point being, there's a lot of PE out there that doesn't know operations, but the ones that are very successful and are going to be successful are going to have to know the businesses that they're buying. It's inevitable. A lot of folks have relied on consistent growth in the economy for years and have made a lot of money without knowing a whole lot, frankly. But I think the rubber's about to meet the road, so to speak. So knowing that part of the business is going to be key.
Yeah, tell me a little bit more about your last statement about the rubber meeting the road, because I too have met the guys that focus on cager, and my feeling is they're about to find themselves in cages.
I don't know. I don't know about that. I mean, we're due for, and who knows whether or when it happens, but we're due for an economic downturn. We do have significant unemployment with a dearth of skilled or semi-skilled labor, in the market, and we had a new administration coming in. That there's certainly some questions as to how it's going to affect the economy. So, I'm not predicting anything, but it would seem where we are, there's certainly an opportunity for a disruption, and it's not going to be just consistent growth for the next 12 years as it has been for the last 12, or relatively consistent.
Right, and that's interesting. So this next question is for both of you. I spent my life on Wall Street, growing up on Wall Street, and I'm an economist way back in training. And so when I look at the macro economy, there are certain curves that don't change. Supply demand doesn't change, and when you print an inordinate amount of money, of fiat currency, and every central bank is producing an inordinate amount of fiat currency, my biggest fear, and this may just be a side conversation, my biggest fear is that one day we wake up and we find out that China determines, 1% doesn't really look so good to prop up America and do the things that they want to do for themselves. I think I'd rather put the money in my own economy at 6 or 7%, and I don't really want to support I'll take a shot at it, the Great Green New Deal. I don't want to support their $2 trillion habit of spending. And to me, that's one of the biggest fears that's out there that's unspoken, is we are living in a world where it's a competitive world, and the global economy has nation states in it that are competing for scarce capital, and they all have huge debt structures now and have to be propped up. So ultimately, they will compete for capital. And when they compete for that capital, who's going to be the first one that says, I'm not playing the game at 1% anymore. I have a stronger need internally. I'm going to raise my rates to 1.5. And the rates begin then to break through and go to the other side. So I look out 3 to 5 years and I say, there are some questions, there are some clouds. There's a global economy that dictates a lot more of what happens here than people recognize. Are these things that are going to come home to roost at some point in time? And Mike is very optimistic, so I'm going to let him start with the question and see what his response is. And I'd love to get your feedback as we're feed into it, Josh, on the same side.
Sure.
Well, I did take those great economics courses, and lots of them that were, it's kind of hard to sort them out, which ones were fiction and which ones weren't. But there are jolts. I don't like what I see when, if you ask for a political kind of recap, I certainly don't like what I see. But, I don't spend a lot of time there, quite honestly. All I know is there's not a government entity, whether you're on a nation level, state, county, city, whatever, township, they don't have enough money. They're all starved for money because they had the ability to tax and to print, or print and tax, whichever one you want to say, and the money never goes for the project; it goes for the payroll, and so they're not buying asphalt; they're buying 15 people to stand around watching folks, scatter asphalt. And until that stops, it's not gonna happen. And you can wish it away, and it's not gonna. I don't think it's just gotten worse. So there's an insatiable desire. There's real projects out there, so they will get them funded. I mean, there are potholes, okay. There are bridges that are falling down. There's lots of things. They're going to get the money, and so they'll keep doing it until they get all of the money, and then the bridges still fall down. So. Um, I don't know. That's for you young guys to figure out, because I look at it, it's not going to change. I mean, it hadn't changed in my lifetime. Um, it just doesn't. They
Okay,
find a way to manipulate the systems. There are going to be some failures. I mean, you look at the euro, for goodness sakes. It's going, well. Let's see. It was about 110 this time last year to the dollar, 122. What does that tell you about the U.S. currency and your China theory? And it's just, things are moving around the world. There's the economies. You have some that are going to do extraordinarily well, and some that just won't. I think the problem is we're propping up a lot of folks that, whether it's a country, whether it is a company, propping up the airlines or whatever else it is. We just have a tendency to prop up things that need to have that have gotten past their expiration date. They need to be off the shelf.
Right. So to that point, there are two.
And you can tell I'm not running for office this time.
No.
I'm backing off. I'm backing off.
I think you got three guys here that are going to back right off and maintain their lifestyle. But to your point, I do believe that there's a lot of economic charts and theories and things that go all over the place. But there are two that I think are fundamentally sound and never change. One is supply and demand. I think that's always going to be there, no matter what it is. Supply and demand is the lower the supply, the higher the demand, the higher the price for it. And the second is the crowding out theory of capital. So as the government has a greater and greater thirst, right now they're reversing. They're printing money on one side and supplying on the other. So they're not crowding out; they're flooding. But at some point, that has to come back home, and you've got local places that don't have enough capital and have to tax, and all of that creates demand on ultimately the individual and the business. So the question is not so much the political world, but does it give you any cause to take a breath and say, "Whoa, 3 to 5 years from now, I'm a business owner. I'm running this business. I'm in my 50s or 60s. I've built a great business. I'm thinking about maybe when is the time to exit." Multiples seem to be at an extraordinarily high level right now because there's a lot of money chasing deals, and good deals in particular, good companies in particular. If I'm looking out 3 to 5 years and I'm one of these people in the lower middle market that's facing this labor challenge, this technology challenge, all these other things, do you stop and say to yourself, maybe this is a good time to take the chips off the table, because maybe in 3 to 5 years I'm just running the other side of the gerbil wheel and I've got to wait a full cycle to get back to where I am today? Or is that a valid thought?
Yes, it's a valid thought. Now, I would say, when you say take the chips off the table, there's not and I've probably already said this, there's not a one-size-fits-all approach necessarily, but if you're in that category and you're in that group, it's time to, if it's me, it's time to start looking at my opportunities. Is there an opportunity to sell? Is there an opportunity to take on some strategic investment with a group that knows my industry and knows how to help me achieve my goals or continue, into the future. Is there an opportunity to do something along the lines of an ESOP and take some cash off the table, stay in my role for all intents and purposes, but also give my employees some additional incentive and some opportunity to participate in the equity of the business. Is there an opportunity to go find another business that would what's the word, create some synergies, that would add, be accretive to what I'm doing, or I've lost the word, but nevertheless, are there opportunities for add-ons or for consolidations? It's not time to stand still, I wouldn't think. And then, the other part of that is, if the exit is imminent, or the exit is likely in the next 3 to 5 years, there's a lot of planning opportunities that people really should consider. There are certainly tax planning and estate planning and other types of planning opportunities that, when that day does come, you can avoid. Avoid's probably not the best word, but you can eliminate some of your tax burden down the road, and take it, set up your family for the future. So it's not I wouldn't look at it as it's time to sell, let's sell the company, but it's certainly time to consider what our options are.
How do you feel about that, Mike?
Yeah, well, I agree. I mean, we're not afraid to sell companies. I mean, we're because we're kind of in the tech business, and so it's if you don't sell after about 10 years, you almost become obsolete. So it's a little different atmosphere, but I will say that I truly believe it's from an owner standpoint, it's going to be hard work. It's never not been hard work, but I really think that there's so much. CBS Evening News, death is coming to all of us mentality that I think it really gets into everybody's psyche, and it's going to be hard work. But you have to get past that, because it is hard. And I think what we're suggesting to folks is that really, if you're thinking about selling, and it's logical, I mean, that's what business is. You're supposed to make money, and so, but I think you owe it to yourself to really look at your strategy. And I don't know, strategy's always been rather simplistic to me, and that is, it's just all about how do you position your company to take business away from your competition. I mean, it's not that hard. And this, what my sense is that there are so many companies that, if you look at your competition, I mean, who dropped out this past year? I mean, we talk about problems, and there have been some huge problems. And you just got to go, okay, who's dropped out, and then who are the new players that are coming in because they had a problem in their other industry and they view your industry as even better. And so you really have got to look at that, as well as, and you talk about the tax structure and all of those things that need to be looked at. But from just the basic decision, I really think you have to pay attention to your corporate structure, not just your products, but your corporate structure. And that is that, yeah. And I think, Josh, you said you were with a supply company. I think it was Ferguson. Is that right?
That's right.
Okay. So, I mean, you were with a great company. And so what's happening to vendors today is that these, they have instigated some incredibly difficult hurdles for companies to sell into their companies because they got burned. The supply chain thing is, I don't care whether you're selling masks to hospitals or, crab legs to, some cruise line. You've got all kinds of supply problems. And if your company, the hard work I'm talking about, if you can't realistically assess where you are in the market, who your competitors are, and whether or not your profile is good enough so that you can be a customer of somebody else, the time is to sell. you really need to sell because it's hard work to accomplish all of those other things. But it's never really. Peter Drucker would tell you the same thing if he were around.
Peter, yeah. There's
It's
a
hard
name.
work.
Yeah, and I think it is hard work. And as you talk about the supply chain, I immediately go to my fabrication clients, and they can't buy steel. There's
Yeah,
no
yeah.
steel around. The price of steel is jumping every other day, 4 or 5%. It's unbelievable what's going on, and it's not as much a demand problem as it is a supply problem.
Mhm.
And some of it goes to the labor, some of it goes to technology, some of it goes to the virus. But it is an enormous problem. Which, on the other side of it, everybody in that industry understands that the house of cards will come down on the other side, and when the supply comes on, the prices are going to crash. It's just, and there's going to be trouble on that side as well. But there is a supply problem. There's a supply in labor, supply in materials, there's supply in all that. For the business owners that are out there, I think what you're pointing out, Mike, and you too, Josh, is that these business owners need to be thinking about their businesses in a somewhat different model than get up every day and go do the same thing. It's almost as though they need to extract themselves from the business, elevate above the business, and look at it from 10,000 feet again, and stop working at the business for a few minutes and work on the business to understand the landscape of where they are. Is that fair?
Totally.
I agree.
So,
Absolutely.
so with that, as we begin to get into the final minutes of the session, uh, what what advice or thoughts would each of you have in terms of the key things that people need to be looking for as they're thinking about whether or not to make that crossroads decision of stay or go, which is really the theme today? Given all those information we've put together, what would be the 2 or 3 critical crossroad points when they take an inventory not only of the business, but as you know, in any sales situation, what you were talking about, Mike, really had nothing to do with the business. It was an inventory of self. It was, what do you have the appetite for? What is the hard work that you are willing to engage in? Because hard work, your definition of hard work, my definition of hard work, Josh's definition of hard work, is probably very different than many other people's definition of hard work. And as you get into the 40s and 30-year-olds, it's clearly a difference there. So hard work is a relative term. So I really think you were talking, correct me if I'm wrong, was about taking an internal inventory of yourself as an owner. And what are those key things as somebody, both of you, Josh, you worked with a lot of people and understand it and see it through that experience. Mike, you are one of those people that has had as much success as you had. I am sure you have had your share of scraped up knees someplace.
Josh, I'll let you start.
Sure.
If there's
Sure.
time
Well,
left, I'll share my scars.
well, I was just going to say, speaking to Mike's good point about taking the self inventory. Once that's done, and you know where you are, or know what your opportunities are, or know where you are, or know where you want to go, or know that you want out, it's taking a step back and asking yourself or others, what are the options? If I decide to sell, who can I sell to? Is there a strategic buyer out there that's a natural fit? Is there a vendor or a customer out there that's a natural fit? Or should I engage with a banker or a lawyer and go do a search of the market? I mean, or do we do a full blown auction process? And I know those options are kind of all over the map, but it's really, once you decide you want to do something, you have to take a step back and determine how do you affect that sale or strategic opportunity. And I obviously we all want to sell our services, and I'm not saying that it can't be done.
Oh, go for the shameless plug. It's okay.
I'm not saying it can't be done alone, but a 2-hour conversation with a Matt Saltzman may be just what you need. And Matt may sell you his services or tell you you don't need him. You can do this, or this, or talk to this other person. But having those conversations and making sure you have. I mean, successful business folks all have their personal advisors. So I'm not telling anybody anything, but it's asking and looking what are the opportunities out there and making sure that it's not one, making sure that there are some, and making sure that they're the best fit for you. So
Right, and just to tag onto that, and then we'll go to Mike. I'm a big believer in that. You don't try this at home alone. This is for professionals theory, and even if you make that decision that it's time to go, that road is fraught with peril. And if you don't have competent advisors around you, the person on the other side very well may, and that can. And this thing is very tricky. It's not so straightforward. There's a lot of moving parts in this. So you need to have that. On the other side of it, I think one of the things that's often overlooked by people in this decision set from a business owner's perspective is what's next? What's the next chapter? What do I do when my entire identity or a bulk of my identity has been wrapped up in this business for so long? If I'm out, what do I do with the rest of my life? Because it's about personal fulfillment as well. And I think that's a major decision that goes into it as well for them in terms of, family and personal goals and what do they really want to do with the rest of their lives. And no matter how much money there is, if you're not fulfilled, it's really not going to be satisfying. Mike, we've still got time, so I'd love to hear your thoughts on this as well.
Can I jump in real quick before Mike starts? I apologize, Mike, but one thing I didn't say, and I wanted to add on to what Matt said, is there are also often opportunities, and there's often a need to take some time and make yourself more attractive or get yourself ready for taking advantage of that opportunity. And there are certain steps within the company and outside the company that folks can take to make themselves more attractive to that strategic buyer or to that financial buyer, or whoever the potential exit or strategic opportunity is. So I don't think I said that, so I wanted to add that. Sorry.
Yeah, and I think that's a place where somebody like you can give a lot of help and a lot of insight to somebody.
I certainly hope so.
Yeah. And I'm gonna agree with both of you guys because I don't have to be as blunt as I can get. If you're a business owner and you don't get the best people in the room you can, you're an idiot. Because what happens is you know your product. I mean, you live it, you breathe it 26 hours a day, and you have for a gazillion years, and you're proud of it, and it's hard to look at it. I mean, that's your baby, and you don't really want somebody to call it ugly, but you got it. You can't be Pollyanna. This particular decision is a decision of a lifetime. I mean, in our case, we get a couple of cracks at it because our life cycle is different. So, but for most people, it's a decision of a lifetime that affects them and their family tree forever. They've got a chance to change their family tree forever, and they better get the right kind of folks around there. And you're going to pick some stinkers. I've fired some people along the way that I didn't feel like were a fit. They knew a lot of stuff. It's just they didn't fit with the rest of the advisors that I had around the table. But you better get them because there's millions of dollars at stake. And Matt, as you said, and their identities at stake. And so, no, you really have got to be realistic and find somebody that you trust. And Josh, you had some kind of I think you said 5 years, whatever. It took us a long time to learn to dance. We didn't know anything. I mean, we got an investment banker from Chicago, and we interviewed a lot of folks, and and he's a marvelous friend. He gave us great advice, marvelous friend. And then he brought his players along that fit with him along the way. And it just made us a better company. It gave us the focus. It pointed out investment bankers are wonderful people. You've ever met one that you didn't like? I mean, they will charm you into doing the right things. It's not hard. It's not like getting a COVID test. You have to stick that tube up your nose. No, don't even. It's easy. It is really easy, and it's so important to your family because all you want is somebody at the end of the day to say, look, I'll give you a bunch of money, and it's more than you can make if you kept the company yourself. I mean, they're fairly straightforward kind of questions and answers, but you got to have the right people around the room who can, you got to have, you may even need a former owner to say, this is what I did. It may the circumstances may be different, but here's what we did. Here's our story. We tell our story a lot. We had a private equity. We had Bain Capital when we did a recap in '06, and our investment banker, who we loved, out of Chicago, said you need to get some private equity guys out of the room. And I said, I know I'm from Elizabethtown, Kentucky, but do I look stupid? I know all those people are SOBs. Why would we want to have them in the room? And he said, trust me, it's the single best business decision we made was to bring smart people around the table. And the PE guys and Bain, they're still our partners in the other company. We had the identically same board as we had at iPay. We have the same 14 people around that table for 8 people around that same table for 14 years. I mean, it's the best business decision ever made to bring other people in there that could help us think through the business.
No, I think that's a very strong point in that you can never have enough brains at the table and enough experience at the table. And it's the little things. We had a client that was selling, and it's a little thing, such as the restructure of a lease with the buyer and how we form those payments, created extra EBITDA. That extra $50,000 at EBITDA was $350,000 in their pocket at closing because of the multiple.
Yeah.
And it was something they never thought about. The PE group went with it that was buying it. They understood the logic of it, but it was about having good people in the room that could create and craft those kinds of solutions that made all the sense in the world. So I'm pleased that you said that, because I do think that no matter what you do in this world, you can never get hurt by having smart people around you. And I always believe I want to be not the smartest guy in the room. I want to be the dumbest guy in the room and have those other people working for me to help me.
Yeah, and you do need to be. It needs to be choreographed like a wonderful dinner party, because you've got to have the right people who not only get along with you, the company, and the management, but to get along with the other purveyors of the around the table and the opinions. They've got to get along with each other. You got a disaster. So it's all about choreography. Got to do it. Got to do it.
Yep. And in addition to that, what happens is, to your point about Bain, you bring somebody like Josh into the meeting with you. It's not just Josh. Josh has an entire network that extends beyond him and corporate resources that come to the party with him. Whether they're in the room or they're not, they can be called upon. And when you start to put 3 or 4 of these people together, the network that extends beyond, that's at your disposal, are places you never even knew existed as a seller or an owner. And it's tremendous how that helps you, as you said, to your point, grow into the future. And I think that's really the key on this thing. So it's been a good conversation. We do have a hard stop at this point, but it's been a really good conversation. I want to thank both Mike and Josh, both of you, really, for participating with me on this. That was a quick hour, I will say that, and it was fun. It's interesting. We covered a lot of ground and a lot of territory. Hopefully, the people that watch this will get things out of it and be able to reach out and answer some of their own questions. In closing, I just want to thank both of you for participating. I wish you both, a great Christmas and a happy New Year to you and to everybody watching this. I can only say 2021 has to be easier than 2020 in any way.